The price hit $82.14 on Monday morning. Then it collapsed to $73 by Thursday afternoon. The financial media called it profit-taking. They called it year-end volatility. They called it a technical correction after an extraordinary rally that saw silver surge nearly 200% in 12 months. But while everyone was staring at the charts, something else was happening in the physical world. Something that makes the price movement almost irrelevant compared to what's unfolding in the industrial supply chain. This discussion is for educational and analytical purposes only, and does not constitute financial advice. The headline writers focused on the margin hikes. The Chicago Mercantile Exchange raised initial margin requirements for silver futures contracts to $25,000, a 13.6% increase that effectively tripled the cost of entry for many traders compared to early 2025. The analysts called it a classic intervention. They compared it to Silver Thursday in 1980, when the Hunt brothers were forced into liquidation after similar rule changes. The narrative was clean, the system worked, order was restored. But the margin hikes were a symptom, not a cause. The real story is playing out in refineries across Switzerland, wholesalers in Texas, and manufacturing facilities from Shanghai to Stuttgart. The real story is about what happens when a commodity transitions from being a monetary asset to becoming a critical industrial input. When that transition occurs, the old rules stop working. The old mechanisms break down. The market enters a new phase where traditional price discovery becomes disconnected from physical availability. We are witnessing that phase transition now. The structural forces that drove silver from $15 to over $80 are not cyclical. They are not speculative. They represent a fundamental shift in how civilization consumes materials. And that shift is accelerating at precisely the moment when the supply side is showing signs of exhaustion. The technology driving this transformation has been quietly scaling for months. While everyone was watching Bitcoin and monitoring Federal Reserve policy, a revolution was taking place in the way we generate and store energy. Advanced photovoltaic cells are now being manufactured with silver consumption rates that dwarf anything seen in previous generations of solar technology. The new tunnel oxide passivated contact cells, known as TOPCon technology, require up to 50% more silver per panel than traditional designs. But the efficiency gains are so substantial that manufacturers cannot afford not to adopt them. Heterojunction technology goes even further. These cells achieve conversion efficiencies above 26%, but they demand precise silver deposition layers that consume material at rates that would have been unthinkable just 5 years ago. The silver is not decorative. It is not optional. It serves as the conductive pathway that captures and transports electrons generated by photons hitting the cell surface. Without sufficient silver content, the cells simply do not function at commercial efficiency levels. This is not a laboratory curiosity. China's National Energy Administration announced plans to add 160 gigawatts of solar capacity in 2025 alone. The European Union has set a target of 700 gigawatts by 2030. The United States is subsidizing domestic solar manufacturing at unprecedented levels. Each gigawatt of installed capacity requires approximately 1.5 million ounces of silver when using advanced cell technologies. The mathematics are straightforward. The implications are staggering. But solar is only one vector of demand growth. Electric vehicles are consuming silver at rates that mining companies did not anticipate when they planned current production levels 5 years ago. An internal combustion engine vehicle typically contains 15 to 20 grams of silver in various electrical components. An electric vehicle requires 30 to 50 grams for battery management systems, power electronics, and charging infrastructure. As global automakers race to meet electrification mandates, this differential becomes systemically significant. The numbers compound quickly. Global automobile production runs at approximately 90 million vehicles annually. If electric vehicle market share reaches 40% by 2028, as current trends suggest, and if the average silver content per electric vehicle is 40 grams, the automotive sector alone would consume roughly 55 million ounces annually just from the transition. That represents nearly 7% of current global mine production dedicated to a single application that barely existed 10 years ago. These demand vectors are converging simultaneously. Solar installations are accelerating. Electric vehicle adoption is mandated by law in multiple jurisdictions. Data centers supporting artificial intelligence applications require silver-containing components for thermal management and electrical connections. Each sector views its silver requirements as non-negotiable. Each sector is competing for the same physical material from a supply base that has been essentially flat for the past 5 years. Global mine production reached 844 million ounces in 2024, representing a modest 2% increase from the previous year. But this figure masks underlying constraints that suggest future growth will be even more limited. Ore grades have been declining consistently. The average silver mine today extracts 4 ounces per ton of ore processed, compared to 15 ounces per ton in 2005. This means mining companies must move 4 times more material to extract the same amount of silver, requiring proportionally more energy, water, labor, and capital equipment. The geological reality is that high-grade silver deposits are increasingly rare. New discoveries tend to be deeper, more remote, and more technically challenging to extract. The permitting process for new mines often spans a decade or longer, particularly in jurisdictions with environmental oversight. Even if silver prices remain at current elevated levels, the supply response will be measured in years, not months. Recycling provides some supplemental supply, but silver recycling rates are fundamentally different from gold recycling rates. Gold achieves recovery rates near 90% because it tends to be concentrated in jewelry and coins that retain their form. Silver is dispersed across thousands of industrial applications in microscopic quantities. Recovering silver from discarded electronics, solar panels, or vehicle components often costs more than the recovered metal is worth, especially when labor and environmental compliance costs are included. The recycling lag creates another constraint. Silver that enters a solar panel today will not return to the supply pool for 20 to 25 years. Silver that enters an electric vehicle battery will not be available for recycling for 15 to 20 years. As industrial demand grows, an increasing percentage of annual mine production becomes sequestered for decades. The available supply for new applications shrinks even if total demand appears stable. This supply-demand imbalance has created conditions that traditional commodity markets are not designed to handle. When a material transitions from being primarily monetary to being primarily industrial, the elasticity of demand changes fundamentally. A jewelry manufacturer can delay purchases if silver prices spike. A solar panel manufacturer facing delivery deadlines for utility-scale projects cannot. An automotive company with regulatory requirements for electric vehicle production cannot substitute materials without redesigning entire electrical systems. The recent price volatility reflects this transition period. Financial markets are still treating silver as if it responds to monetary policy, risk sentiment, and speculative flows, but an increasing percentage of demand comes from industrial users who must secure physical material regardless of price fluctuations. This creates a bifurcation where paper prices can be manipulated through margin changes and trading restrictions, while physical availability becomes increasingly constrained. The margin hikes that triggered the recent price decline represent an attempt to restore order to a market that is fundamentally changing character. But margin requirements affect financial speculators, not industrial consumers. Tesla does not buy silver on margin. Samsung does not hedge its silver procurement through futures contracts. Major solar manufacturers negotiate direct supply agreements with miners and refiners. The financial tail is attempting to wag the physical dog, but the physics of material consumption ultimately determines the outcome. When commodities enter structural deficit conditions, market dynamics become nonlinear. Small changes in demand or supply can trigger disproportionate price movements because there is no inventory buffer to absorb imbalances. Silver inventories in exchange-registered warehouses have been declining for consecutive months. The London Bullion Market Association reported similar drawdowns in allocated silver holdings. Physical dealers are experiencing delivery delays that were unthinkable when silver traded below $30. This inventory depletion is occurring precisely as industrial demand is accelerating. The timing suggests we have crossed a threshold where the market's ability to balance supply and demand through price adjustments alone may be insufficient. When that happens, allocation becomes the primary mechanism for distributing scarce materials. Industrial users with long-term contracts and strategic relationships receive priority access. Spot buyers face increasing premiums and extended delivery times. The psychological aspect of this transition cannot be overlooked. Market participants are struggling to reconcile traditional monetary analysis with emerging industrial realities. Silver has been viewed as gold's volatile younger sibling for decades. That framework becomes less relevant when silver's primary value driver shifts from monetary demand to technological necessity. The cognitive dissonance began around 3 o'clock Thursday afternoon. Silver had opened the session at $78 and change, trading within normal ranges despite the margin hikes that had dominated headlines since Monday. Then something shifted. Not in the price action, which remained choppy but unremarkable. The shift occurred in the physical world, where industrial procurement officers were placing calls that would have been unthinkable just 6 months earlier. A major solar panel manufacturer in Germany contacted 3 separate Swiss refineries within the span of 2 hours. Each conversation followed the same pattern. The manufacturer needed immediate delivery of refined silver granules for a production line that could not be shut down without triggering penalty clauses worth tens of millions of euros. Each refinery provided the same response: no available inventory. no delivery timeline, no alternative suggestions. This was not a temporary liquidity squeeze. This was not speculative positioning. This was the moment when decades of gradual industrial transformation crossed a threshold into acute material constraint. The financial markets were still processing silver as a precious metal subject to monetary influences and trading psychology, but the physical reality had already shifted into a different regime entirely. While analysts debated margin requirements and technical chart patterns, the infrastructure supporting advanced energy technology was consuming silver at rates that mining companies had not anticipated when they planned current production capacity. The consumption was not optional, the applications were not substitutable, the demand was not elastic, and the timeline for supply response was measured in years, not quarters. This discussion is for educational and analytical purposes only and does not constitute financial advice. The technology driving this transformation has been scaling quietly in manufacturing facilities across 3 continents. Advanced photovoltaic cell production represents a fundamental departure from traditional solar panel manufacturing, but the material science implications were not immediately obvious to commodity analysts focused on monetary policy and risk sentiment. Traditional silicon solar cells relied on screen-printed silver paste applied in relatively thick layers across the cell surface. The process was straightforward but inefficient, both in terms of energy conversion and material utilization. Silver served as the conductive grid that collected electrons generated by photons striking the silicon substrate. More silver generally meant better conductivity, but diminishing returns limited how much manufacturers were willing to use when silver traded below $25 per ounce. The breakthrough came through precision deposition techniques that allow manufacturers to create much thinner conductive layers while achieving superior electrical performance. Tunnel oxide passivated contact technology, known as TOPCon, requires silver to be deposited in precisely controlled patterns that maximize electron collection while minimizing resistance losses. The silver content per cell actually increases compared to traditional designs, but the efficiency gains are so substantial that the cost per watt of generated electricity decreases significantly. Heterojunction technology pushes these principles even further. These cells achieve conversion efficiencies approaching 27% by layering different types of silicon with precisely engineered silver interconnects. The silver deposition must meet tolerances measured in nanometers. Any reduction in silver content compromises the electrical characteristics that make the technology viable. The silver becomes integral to the cell architecture rather than simply a conductive coating applied to a finished substrate. The scaling of these technologies was gradual enough that commodity markets initially absorbed the additional demand without significant price pressure. But the timeline for industrial adoption has compressed dramatically over the past 18 months. China's commitment to adding 160 gigawatts of solar capacity in 2025 requires manufacturing infrastructure that was designed around advanced cell technologies. European subsidy programs specifically incentivize high-efficiency installations that rely on TOPCon or heterojunction cells. American manufacturing initiatives include requirements for domestic content that favor advanced technologies with superior performance characteristics. Each gigawatt of installed capacity using advanced cell technologies requires approximately 1.5 million ounces of silver when accounting for manufacturing yields and quality control requirements. The European Union's target of 700 gigawatts by 2030 translates to over 1 billion ounces of cumulative silver demand just from that single regional deployment goal. China's annual installation targets suggest similar consumption levels sustained over multiple years, but solar represents only one vector of demand acceleration. Electric vehicle adoption has created consumption patterns that mining companies did not model when they planned current production levels. The differential between internal combustion engines and electric vehicles extends beyond simple component counts into fundamental system architecture requirements. Traditional automotive electrical systems operate on 12-volt direct current with relatively modest power requirements. Starting systems, lighting, and basic electronics consume silver in small quantities distributed across multiple components. An internal combustion engine vehicle typically contains 15 to 20 grams of silver in window switches, seat motors, electronic control units, and similar applications. Electric vehicles operate on high-voltage direct current systems that demand superior electrical performance from every component. Battery management systems must monitor and control hundreds of individual cells with precision that requires silver-containing sensors and switching devices. Power electronics that convert direct current from batteries into alternating current for electric motors rely on silver for thermal management and electrical connections. Charging infrastructure requires silver-containing components that can handle repeated high-current cycling without degradation. The cumulative effect increases silver content per electric vehicle to 30 to 50 grams, with luxury vehicles and commercial applications requiring even higher amounts. As global automakers race to meet electrification mandates imposed by regulatory authorities, this differential becomes systemically significant. Current global automobile production approximates 90 million vehicles annually. If electric vehicle market share reaches 40% by 2028, as regulatory timelines and manufacturer commitments suggest, the automotive sector alone would consume roughly 55 million ounces annually just from the transition differential. That represents approximately 7% of current global mine production dedicated to a single application that barely existed as a significant demand vector 10 years ago. These consumption vectors are converging simultaneously rather than sequentially. Solar installations are accelerating under regulatory mandates and subsidy programs. Electric vehicle adoption is required by law in multiple jurisdictions with specific timeline requirements. Data centers supporting artificial intelligence applications require silver-containing components for thermal management and high-frequency electrical connections. Each sector views its silver requirements as technically non-negotiable. Each sector competes for the same physical material from a supply base that has shown minimal growth over the past 5 years. Conservative demand modeling assumes current adoption rates continue without acceleration. Under that scenario, industrial silver consumption grows from approximately 680 million ounces in 2024 to roughly 750 million ounces by 2027. The increase of 70 million ounces represents nearly 10% of current annual mine production. Moderate acceleration scenarios incorporate announced policy commitments and manufacturer investment plans. Solar deployment targets established by major economies suggest industrial demand could reach 850 million ounces by 2027. If efficiency improvements partially offset consumption increases per gigawatt installed. Electric vehicle mandates and battery technology scaling could add another 40 million ounces annually by the same time frame. Aggressive scenarios consider the possibility that technological breakthroughs in energy storage or semiconductor applications create additional demand vectors that current modeling does not anticipate. Advanced battery chemistries under development require silver for electrode coatings and thermal management systems. Next-generation semiconductor devices for artificial intelligence processing rely on silver for heat dissipation and electrical connections. If these applications scale rapidly, industrial demand could approach 950 million ounces annually within 4 years. Even conservative scenarios suggest industrial demand growth that exceeds historical mining supply growth by substantial margins. Moderate and aggressive scenarios imply demand growth that would require mining supply increases of 15 to 20% within 3 to 4 years to maintain current inventory levels. Global silver mine production reached 844 million ounces in 2024, representing modest growth from previous years, but reflecting underlying constraints that limit future expansion potential. The apparent supply increase masks deteriorating ore quality that requires increasing amounts of energy, water, and labor to extract equivalent quantities of refined silver. Average silver ore grades have declined consistently over the past 2 decades. Mines that extracted 15 ounces per ton in 2005 now typically yield 4 ounces per ton from similar geological formations. This degradation means mining companies must process 4 times more ore to extract equivalent silver quantities, requiring proportional increases in diesel fuel, crushing equipment, chemical processing, and waste disposal capacity. New silver discoveries tend to be located in increasingly remote or politically unstable regions. Permitting timelines for new mining operations often span 8 to 12 years in jurisdictions with environmental oversight requirements. Even if silver prices remain elevated, the supply response timeline extends well beyond the demand acceleration period created by industrial technology scaling. Approximately 70% of global silver production comes as a byproduct of copper, lead, zinc, and gold mining operations. Primary silver mines represent a minority of total production, which means silver prices alone do not drive supply decisions for most mining companies. Base metal demand and pricing cycles influence silver supply more directly than silver market conditions. The physical reality has already begun to override financial market signals. While exchanges adjust margin requirements and analysts debate price targets, industrial procurement managers are making decisions based on material availability rather than chart patterns. The transition from monetary asset to critical industrial input appears irreversible at current consumption trajectories. The structural changes driving this transformation operate on timelines that extend beyond typical market cycles. Advanced energy technologies require years to scale from laboratory prototypes to mass production. Mining operations require decades to develop from initial exploration to commercial output. The mismatch between demand acceleration and supply response suggests this phase transition will continue regardless of short-term price volatility or regulatory interventions. What changed was not the price action itself, but the underlying physics of how civilization generates and stores energy. Silver's role in that infrastructure has crossed from optional to essential, creating demand characteristics that traditional commodity markets struggle to accommodate. The wall that silver's rally encountered was not financial resistance, but the fundamental constraint of physical scarcity meeting technological necessity.